Good morning, friends. This is practicing advocate Sriman Narayana Malila, enrolled with the AP High Court and serving as tax litigation advocate and legal counsel for other high courts, mainly deal with tax matters and corporate matters. Now, I am going to talk about materiality, risk assessment, internal control, and internal audit. These are the topics I'm going to talk on those. Basically, I'm a CA inter completed in 2012. CA final still pending, and the final is still pursuing. I am, and that's the reason what I know the knowledge I'm planning to share with my fraternity and who are all interested in these topics. Friends, I'll start now. Just a few minutes. Friends, this is practicing advocate Sriman Narayana Malila talking about materiality, risk assessment, and internal control and internal audit. The materiality and risk assessment now I'll talk. See, the risk assessment assess the level of risk in a business process. Wherever you go, you started a business, or if you're appointed as an auditor for the one entity, then you need to assess the risk. Understanding, friend? You need to assess the risk. 1 minute. Friends, first, being an auditor, being an auditor, you need to understand the risk with the entity and assess the level of risk in a business process and consider the business environment, regulatory environment, organizational structure, and management concerns. Focus on the area of the greater risk by identifying assertions that might have material misstatement. A skepticism in evaluating the procedures, selecting an inappropriate audit procedure, misplaying an appropriate audit procedure, misinterpreting results from an audit procedure, audit risk. The risk of giving an inappropriate audit opinion, financial statements, that are materially misstated. Components of the audit risk. Friends, understood what is meant by risk assessment? A risk assessment, being an auditor, first you assess the risk. You need to consider the business environment. You need to focus the area of the greater risk is where existed, and the spectrism of the evaluating the procedures. Selecting inappropriate audit procedure leads to material misstatement. Misplaying an appropriate audit procedures, misinterpreting the results from an audit procedure. Understanding, friends? Audit risk, the risk is the risk of giving inappropriate audit opinion, financial statements that are materially misstated. Okay, friends? Next. Components of audit risk. Inherent risk. Susceptibility of an assertion to misstatement without considering related internal controls and examples. Technological changes. Caching inventory to be more susceptible to overstatement. Business risk related to the entity objective, operations and industry. Risk of the particular concern to the auditor includes complex calculations prone to the errors, high value of inventory at risk of the misstatement, uncertain accounting estimates with measurement challenges, insufficient working capital of affecting the operations, volatile industry with frequent business failures. Volatile industry with the frequent business failures. A technological changes making product obsolete. Tell friends, the component of risk. The component of risk comprises these are the below. What are those? Technological changes, technological changes, and business risk, complex calculations, high value of inventory, accounting estimates, insufficient of the working capital, frequent business failures. Frequent business failures. All these, all these are, all these are elements or components involved into the audit risk. Friends, understanding what I mean to say, the inherent risk is comprises of susceptibility of an assertion of the misstatement. Those may be technological changes, business risk, complex calculations, maybe high value of inventory, and uncertain of accounting estimates, and insufficient of the working capital, and frequent business failure models. All these are the combination into the business risk. Control risk. Risk that internal control will not prevent, detect, or correct material misstatements on time. The entity must assess the business risk and implement control to manage them. Entity level controls, board oversight apply to all assertions. Activity level control relate to specific assertions. Same control risk always exists due to limitations of the internal control system. Detection risk. Risk that the auditor will not detect a material misstatements even though performing audit procedures. Auditor identify areas with high risk of misstatement and apply audit procedures accordingly. Also also consider possibility of, these are examples of non sampling risk as well. Inappropriate the procedure selected, incorrect applications of the right procedure, misinterpretation of the results. Audit risk material misstatement into detection risk. Audit risk is called risk of the material misstatement into detection risk. Risk of the material misstatement is called inherent risk and control risk. Risk of the material misstatement is called inherent risk and control risk. The procedures are performed correctly. The combined level of internal risk, inherent risk, control risk, inverse related to detection risk. Audit materiality is inverse related to audit risk. Maintainability, audit maintainability. The audit materiality is inverse related to the audit risk. So, the materiality is equal audit risk. Audit risk is equal inherent risk into control risk into detection risk. The audit risk is equal inherent risk will multiplied by the control risk. Control risk will multiplied by the detection risk. Understanding, friends? The level of assessment and risk of the material misstatement. The financial statement level. Risk that affects the financial statement as a whole and potentially impact many assertions. Example, if top accountant is not competent, error could affect the multiple areas of the financial statement: accuracy, existency, valuation. These risks are pervasive and are not confined to a single account, transaction, or disclosure. Example, errors in the financial statement may not be limited to the one specific area, like sales and competence, but could affect the multiple assertions. For example, the errors in the financial statement may not be limited to one specific area, like a sales competences, but could affect multiple assertions. Assertion level. Risk identified risk identified at the specific assertion level for transactions, account balances, and disclosures. Example, each assertion and valuation competences in individually assessed for the risk. The risk is assessed individually for each assertion in the financial statement. Example, a risk or valuation of a payable may be low, but for inventory affected by obsolescence, it might be high. So, when the level of assessment risk of the material misstatement, you need to see two things. One, financial statement level. Another one is assertion level. Okay, friends. Next, if I look into this, different types of assertions made by the management. What are those? We'll see now. For example, what kind of assertion and what is the meaning of that? That I'll talk now. Occurrence, T and E, travel and entertainment, and events occurred and relate to the entity. That's called assertion. For example, any occurrence means whether event is happened or not. For example, traveling and entertainment expenses, traveling expenses, entertainment expenses, and events occurred and they're relevant to the entity. Completeness, all T and E that should have been recorded are recorded. Accuracy, T and E are recorded appropriately with correct amounts. Cutoff, T and E are recorded in the correct accounting period. Classification, T and E are recorded in the proper accounts. There are different types of assertions. One assertion is called occurrence. Occurrence means, for example, if I take T and E, like travel and entertainment expenses, and events occurred and related to the entity is important. Competences. For example, if you are looking to competences, all T and E, travel and entertainment, that should have been recorded or recorded. Accuracy, T and E are recorded appropriately with correct amounts. Cutoff, T and E are recorded in the correct accounting period. Classification, T and E are recorded in the proper accounts. Friends, if you look into the assertion related accounts balance, for example, existence, assets and liabilities and equity interest exist, and rights and obligations. The entity holds rights to assets and liabilities or its obligations. Completeness, all assets and liabilities and equity balances are recorded. All all assets, comma liabilities and equity balances are recorded. Valuation and allocation. Balances are recorded at appropriate amount with correct valuation and adjustments. Friends, balances are recorded at appropriate amount with correct valuation and adjustments. That's an important. Next, assertion related to presentation and disclosure. Assertion and meaning. Occurrence and rights. Disclosed traveling and entertainment expenses and other matters have occurred and relate to the entity. Completeness. All required disclosures are included. Classification and understandability. Financial information is appropriately presented and described and disclosures are clearly expressed. Understand, friends? Now, accuracy and valuation. The disclosed items are fair and appropriate amount. Okay. Now, there are few steps to the risk identification. What are those? Now we are looking into those. Assets, assess the significance first. What to do? Assess the significance. Assess the significance of the assessed risk and reverse the materiality for the specific account. Determine the likelihood. The risk occurring and impact and audit procedures. Document the assertion that are affected. Consider the impact of risk on each assertion, completeness, existency, accuracy, validity, valuation, presentation. Understood, friends? Any doubts? See, to identify the risk existed with the structure of the business. That's called structural risk. To identify that risk, there are involved into few steps. What are those? First, assess the significance first. What is that significance? The assessed risk and revised materiality for the specific account. So, where materiality is set up and what are the areas it is set up, we need to look into those. Understand, friends? Next, determine likelihood. If the risk occurring and its impact on audit procedures, document the assertion that are affected. Consider the impact of risk on each assertion, completeness, existency, accuracy, validity, valuation, presentation. Considering the impact of risk on each assertion, completeness, completeness, existency, accuracy, validity, valuation, presumption. These are the elements for considering the risk identification. Understood, friends? Anybody doubt? What? If anybody doubt, kindly ask me, friends. Okay. Now, identify significant risk that require separate attention. That require separate attention. Consider the nature and effectiveness of the internal control system in mitigating the risk. Ensure controls are routine. Ensure ensure controls are routine. Designed to designed to prevent or detect and correct errors and assess if they are manual or automated. Assess those if they are manual or automated. Consider any unique characteristics of the risk. Consider inherent risk in transactions, account balances, or disclosures that need further audit procedure. That need further audit procedures. Example: high value of inventory, complex contracts, sales from single customer. All these are steps involved in risk identification. Friends, understood friends? Indicators of possible potential misstatement. Friends, indicators of the possible potential misstatement. What is this? This is completeness. A transaction not identified, source document not prepared, source document not captured, rejected the source document, not represented, existence, fictitious or unauthorized transactions entered, source document overstated, transactions duplicated on the source document, capture of the source document is duplicated, invalid source documents captured on subsidiary ledger, source document captured inaccurately, source document captured inaccurately. Friends, these are now processing of transaction inaccurate, inaccurate adjustments made in subsidiary ledger cut off, transactions recorded in the wrong period. All these are the indicators possible potential misstatement. Understood, friends? Next, risk-based audit approach. Once I completed lunch, I will start next portion. That's called risk-based audit approach. Thank you, friends. Thank you, one and all. If you like my videos, kindly subscribe my channel. You'll be updated by new amendments and good things, good for you in the matter of audit subject and other matters, other tax subject matters, tax subjects, international risk, international taxation, all other stuff. Thank you, friends. Thank you. Thank you, one and all. Bye bye. See you, Tata.